Okay, so let's finish up the last couple sections for chapter 7 here, where we're dealing with perpetual inventory sales. Because the idea of perpetual inventory, right? We're constantly updating our inventory. So that means every purchase that we make, we update our inventories. That means every single sale also affects inventory. So again, the nature of a business when it comes to sales is, once again, we are in the nature of a business is to just ultimately sell a product, right? By taking natural resources, creating a product or a service, and ultimately selling it for a profit. So at the end of the day, the main goal is we are trying to make money. So once again, how do we do that? Well, we have to determine a selling price that will not only cover the cost of purchasing the inventory, but it will also include a certain percentage of profit, right? And that will be determining the selling price. So that means what we're including in that selling price is every single cost it took us to obtain the inventory, but sell it again at a higher price to be able to cover all of those costs. And of course, depending on what state that you live in, okay, we are subject to have to pay sales tax. So in this case, for this class, I just want you to know 8.25%. Okay. So let's take a look at sales. So in this case, right, this example here for June 1st, 10 toys were sold for $9.99 each. Okay, sales tax is 8.25%. And of course, the toys were originally priced or purchased at for $5.85 each. Okay, so let's record this sales. Okay, so in this case, right, first thing is we need to recognize one transaction at a time. Our first goal here is we recognize we sold something. So we need to obtain the cash first, and then we can deal with inventory afterwards. So in this case, right, that's exactly what we're going to do. We have to also recognize the cost of goods sold, but first, we recognize that we sold our products, right? We sold it for cash or accounts receivable, right? We have sales, right? And we recognize the sales tax. So in this case, right, if we sold 10 items at $9.99 each, therefore my total sales was $99.90. Tax is 8.25%, so 8.25% of $99.90 gave me a total of $8.24. So in grand total, I sold a grand total of $108.14. So that's just recognizing the sales portion, okay? Because we are dealing with perpetual inventory, now we have to introduce keeping track of how many items we sold. So in this case, I sold 10. Now, I've also mentioned here how much each item originally cost me. I said it cost me $5.85 each. So in this case, we need to be able to recognize one thing, and that's the cost of goods sold. And where are we taking this out from if we're updating my inventory? Because we sold our inventory, right? We got rid of our inventory. So how do we update our inventory? We take it out from inventory. Makes sense, straightforward. So this is the huge difference between periodic and perpetual sales. Periodic, we ignore taking it out of inventory, right? We wait till the end of the accounting period, then we calculate how much we have and assume we sold this many items. Perpetual inventory, no. You keep track of every purchase, you keep track of every sale. So in this case, I have to calculate what getting rid of 10 of those items cost me. So in this case, right, we've already seen what a cost of goods sold does, right? We're calculating how much it cost me to purchase those items for me to sell to my customers. So in this case, it cost me $5.85 each. I sold 10. 10 times 85, $5.85 gave me $58.50. So Any questions here? Yes.
So the top portion tells how much you're selling.
Yes.
I mean, dollar wise,
Mm-hmm.
how much sale we made, and
Mm-hmm.
then bottom part we are adjusting the inventory.
Correct.
Like how much we sold, how
Correct.
many, or how much worth of item we sold from inventory.
Correct.
Okay.
So this is how we keep track of our inventory, right? Under a perpetual inventory tracking method is that because we sold our inventory, right? That means we got rid of our inventory. So that means we need to adjust our inventory accordingly because we just sold something, right? So again, if I had 100 items and I sold 75, I need to take that out of my inventory immediately. So that means I have 25 left over. That's the same idea here. But why is it imperative that the sales has to come first and then you adjust your inventory? You need to sell the product first in order for you to update your inventory. Okay? So that's the rule of thumb here is you need to get rid of your inventory before you can actually get rid of it. Okay? So you always have to recognize the sales first and know that under perpetual inventory, you have an extra journal entry to adjust your inventory. Okay? All right. So, of course, right, that was it for chapter 7.4 there is recognizing what happens when you sell your perpetual inventory. So, of course, with that, we also have, again, the ability that if a customer can purchase from us, they can also return the product back to us. Okay? There are many reasons why a customer would want to return a product. Okay, maybe they don't like it, they're unhappy with it, maybe it was a gift. Okay, they don't want it anymore. For whatever reasons, they just want to return the product back to you. Okay, but of course, as a company, we have to prevent this from happening because our main goal, right? The nature of a business is to make profits. How can we make profits if our customers have the ability to have unlimited amount of returns and refunds, right? Because there are people out there that do take advantage of the system and would buy a product, use it, and then return it, right? So we have to make some kind of company policy to prevent customers from returning the product because our ultimate goal is to sell our product and keep it sold. So there are many different type of policies you can have there. You can have a limited amount of time frame for you to return the product for a full refund. You can offer store credit. You can have a final sale, no money back. Or you can do a full exchange. Or again, you could just end up just letting them keep the product and issue a new one. Okay? But if you do return, or if a customer does return a product to you, you have to also return a portion of their sales money back. Okay? Sales tax is included because it's not your money, it's their money, and it's their contribution to society. And if they return a product, then you have to return that money back to them. Okay? So, for instance, right, let's say on May 1st, okay, you sold 50 coffee mugs for $5 each, and the sales tax, the coffee mugs cost you $1.25 each. Sales tax is 8.25%. Customer A pays you with cash for these coffee mugs. So let's record this transaction. So once again, right, first thing we got to recognize is we need to recognize the sales. Okay, the sale has happened. So in this case, customer A paid me in cash. So therefore, I'm going to be recognizing I should be receiving cash. We understand that we sold 50 mugs to customer A. So therefore, we recognize that we had a sale. And of course, we're obligated to charge sales tax. So in this case, that's what we need to figure out first. So first off, what was my total amount of sales? Well, 50 times $5 gives you $250. Tax of 8.25% off of those $250 gives you a total of $20.63. So in grand total, you should be receiving $270.63. cents worth of cash. Okay? Once you recognize that you got rid of those 50 coffee mugs, you now need to update your inventory, right? You need to figure out how much it costs you. Of course, when we dive into chapter 8, that's where you're going to get the cost of goods sold because we have to deal with the costing methods, right? But right here, I gave you that each coffee mug cost you $1.25. So in this case, if it costs you $1.25 and you need to get rid of it out of your inventory, well, you sold 50 of them, so 50 times $1.25 is going to give you $62.50, and that's what you need to update your inventory with, okay? Because that's what it cost you to sell those 50 mugs, okay? Now again, do not pay attention or worry about profits because that is not your job. Your job is to simply record the daily business transaction. So in this case, I'm recording that I sold something and that I need to update my inventory. Okay? I don't need to worry about how much money I actually gained or profit. Okay? So, any questions here? So here, I purchased it. Now, let's see what happens when I actually refund it. Okay? So in this case, on May 10, customer A wants to return 10 of those coffee mugs for a full refund. Okay? And of course, your company policy was a full refund within 15 days. Okay? So, of course, the coffee mugs cost you $1.25 each. Okay? So record this transaction. So in this case, right, sales, as we mentioned from the previous one, is the same thing for it doesn't matter what kind of inventory tracking method you're using, right? Sales is finite, right? That means you cannot undo sales. So you still have to use that same account, sales returns and allowances, right? We see it on our receipts, right? Every time we return a product, it gives you a line item that says, here's your original purchase or here's your original sales, this is your discount or this is your refund, okay? And you have it separate. And that's the same idea here where we have to recognize that we are going to be giving a refund. We also have to recognize that we have to give a portion of the money back. And how did the customer pay me? Well, they paid me with cash. Okay? So in this instance, right? Well, how much did we charge each coffee mug? Well, we originally charged each coffee mug at $5 each. So therefore, that's what we have to go off of how much we originally sold it for. Your receipt will normally tell you, again, if it was on sale, then you just do the discounted price, of course. But again, in this case, we're looking at regular pricing, so it was $5 per coffee mug that we originally sold to this customer. So 5 times 10 gives you 50. Okay, so that's how much money you are refunding for the sales. You have to give a portion of the sales tax money back. So what is 8.25% of the $50? $4.13. So therefore, in cash, you should be giving back $54.13. Okay? Now, this is where you have to also think about, okay? If a customer decides to purchase items from you and then they actually decide to return the product back to you, what does that mean to you? That means you're getting back the inventory that you originally sold to this customer. So therefore, you also need to recognize that you're gaining back the inventory that you sold. Okay? Now, for this sake of this example, I'm just gonna put it back into my inventory. Okay? Rule of thumb is in reality, of course, you wouldn't actually put, old stuff with the new stuff. Okay? You would create a separate account that's still inventory, but it's going to be titled something else, right? Refurbished goods, returned items. I don't care, right? As long as you understand that you are still increasing your inventory at the end of the day, okay? Because this time you're getting a refund, or the item is being refunded back to you. So in this case, you also have to undo the cost of goods sold, because in this case, right, you never sold the product to begin with, right? That's the idea. When you get the product back to you, you never sold that product to begin with, so you have to take it out from the cost of goods sold. Okay, so this is one of the exceptions where if you have this kind of expense, this is where you can flip and flop with this type of expense, because it's like it's as if you never sold it to begin with. Okay. So if each coffee mug costs you $1.25, then you're just gonna have to do the same thing. They're returning 10 of those coffee mugs back to you. So therefore, I need to return those 10 coffee mugs at $1.25 back into my inventory. So again, you're gonna get $12.50 back into your inventory. Okay. All right. Any questions here? This only happens for when you receive the inventory items back. Okay, so full refunds is going to be where you have to put it back into your inventory and undo the cost of goods sold. Okay, but what happens when you have an allowance? Okay, so this time on May 18, customer A wants to return 10 coffee mugs, okay, for a full refund. But once again, because the customer just doesn't like the color, okay, and of course your company policy was that you can only return within 15 days, so they missed that opportunity. So in this case, right, only thing that you can do, because as a small vendor, small shop, you do have, again, the abilities to haggle with your customers, right? So of course, the goal is, as a small business, is you don't want to just let this customer go, because they could be one out of your 20 customers that you have. And the purpose is you want to keep your products sold and not have an angry customer or lose a customer. So in this case, what you did was you kindly offer them, I'm sorry you missed out on the return policy, but what I can do for you is I can give you a 15% discount. I can give you some of the money back, right? So in this case, of course, a customer is going to agree, because any money back is good, right? So they agree that they'll accept that 15% discount. So how do we record this allowance this time? Okay, same thing, right? Because we are going to be essentially returning the portion of the sales, right? Because in this case, right, they're saying, oh, since you missed the discount, or sorry, since you missed out the return date policy, unfortunately, we can't do anything about it except for giving a portion of you of the money back. So at the end of the day, they're keeping the product. So in this case, right, so we have to recognize, well, if we're giving them a discount, we're giving them a discount off the sale price. So here you go, we recognize sales, returns, and allowances, right? This is the allowance portion. Because sales tax is based off of not the quantity, right? It's based off the sales price. We do have to give a portion of that money back as well, okay? So in this case, right, what was 10, okay, 10 times $5, which was $50, right? But we're only giving them 15% back. So therefore, that's only $7.50, okay? So $7.50 is what we're going to give back. We have to include the sales tax, so $7.50 times 8.25% should give you that 62 cents. So therefore, you should be refunding to the customer $8.12, okay? But in this case, the customer ended up also keeping the product. You never got the inventory items back. So in this instance, right, this case, we never got the items refunded back to me, so therefore I do not need to update my inventory, because there's no need to, right? I didn't get the inventory items back. So that's all you need to recognize here. So again, you have to be very careful are you actually getting the product back? And if you are, you need to put it back into your inventory and undo the cost of goods sold. But in this case, right, you let the customer keep the product and just give them a portion of their money back. And that's all you have to do. Okay? Any questions here? Okay. All right. Last section is going to be 7.6, which again, of course, if you're able to sell a product, that means you can also have an actual sales discount. So we talked about this before, right? A great way to get your customers to buy your product is to have a sale, because customers, depending on who they are most likely not willing to pay for an item full price. If they can pay for a discounted price, why not, right? They can buy more items with their dollar. And that's what they want. They would prefer to buy anything that's on sale than rather pay full price, okay? So again, what are these types of discounts, right? Again, this is a discount to the selling price, not the product itself, okay? So make sure you know that this is only taking a portion of the money that you're trying to profit, okay? So in this case, right, what are those kind of opportunities? Well, you can have any promotional discounts, such as a grand opening. Again, you can have the sales for the week, so weekly ads. You can have online deals. You can have, a store-wide sale. All right. So again, you can either choose a in-store opportunity, or you can also give your customers who are on an account also the opportunity to take a discount, okay? So for instance, like any store, right? Hey, if you open up an account with me, I can give you a discount right away. But if you don't, then you lose that opportunity, right? So that is what you can also offer. Okay? So how do we do an in-store sale? So once again, right, here's an example where on June 1st, you sold, or you have a store-wide sale, okay, where everything is going to be 40% off, okay, and a customer buys 10 baseball hats with cash, okay, which originally priced that you sold it for was $10 each, okay, and of course the sales tax is 8.25%, and each baseball hat cost you $2.50 each. So let's record this transaction, okay. So for in-store sales, right, at time of purchase, you're going to automatically recognize, okay, you're going to be receiving cash, you're going to recognize that you're going to be discounting that price, and you're going to recognize that you sold something, and you're going to charge sales tax, right? So once we've done that, right, we have to recognize the sales first before we adjust our inventory. So first off is we sold 10 baseball hats at $10 each. So that's $100, right? But since the discount is going to be 40% off of everything, right? That means we're going to take $40 off of the actual sales price, leaving it to be remaining at $60, okay? And then we're going to take that $60 and multiply the sales tax on it, because again, it's based on what you actually sold. So the sales tax on $60 is going to give you $4.95. So therefore, in grand total for the sales, you're going to be receiving $64.95 for this sale. Okay? And of course, because you actually sold your inventory, right, you also need to recognize the cost of goods sold with updating your inventory. So in this case, right, because you end up getting rid of your inventory, so therefore, how much did each hat cost you? It cost you $2.50 per baseball hat. So in this case, how much did it cost you to sell each one? Well, if you sold 10 of them if you sold 10 of them, right, and it cost you $2.50 each, you multiply that and you're going to get $25 each. or $25 in grand total for selling 10. Okay? So again, you're not discounting what it cost you, you're only discounting the selling price. Okay? Right? Okay. All right, and then last one is going to be what happens when you actually give your customers opportunity to take advantage of a discount by giving them terms. So this one, for instance, right? Again, we have the example where on July 1st, okay, your customer wants to buy in bulk 100 baseball hats, okay, from you. And of course, they want to put it on an account, and because they're a first-time buyer, you decide to offer them a 5% discount if they pay you within 15 days. If not, they owe you in grand total in 30 days. Okay, so you offer them terms. Okay, and of course, each hat is sold for $10 each. Okay, and of course, sales tax is 8.25%. And because they decided to buy in bulk, you offer to deliver them for an extra charge of $10. All right, and of course, each hat costs you $2.50 each. So let's go ahead and record this transaction. Okay, so we have to recognize first things first is, well, how did they pay? In this case, they paid by putting it on an account. Okay, so we recognize accounts receivable. We recognize that we sold something to them. We recognize that we charged them tax and we charged them an additional delivery fee. Okay, so first things first is, how much did we sold? We sold 100 hats at $10 each for $1,000. Tax on that $1,000 gave you $82.50. Plus that $10 extra delivery charge gave you a grand total of $10.92.50. Okay? And of course, we also have to recognize, because we end up getting rid of 100 items of my inventory, I need to update my inventory. It cost me $2.50. So $2.50 times 100 gave you $250. Okay? So once again, scenario number one, let's say this customer decides to pay on July 12th, right? And they pay what they purchased from us in full, record this transaction, and the terms was once again 5%, 15, net 30, okay? So again, we originally sold to them on July 1st. They paid on July 12th, so they made the discount due date, okay? So that means I have to now recognize that they are not going to pay me in full. They're going to pay me for the discounted price, okay, of that 5%. So therefore, I have to do my calculations accordingly. I have to recognize, well, how did they pay me? Okay, in this case, I assumed they paid me with cash or some kind of check, right? I have to recognize that they received a sales discount. But because of that, right, I originally charged them full price for the tax. But because they're paying at a discounted price, I have to also give a portion money of that, of the sales discount money back, or I mean sales tax based off of the discount, right? I have to give them the portion of money back because I originally charged them full price, but they're paying for the discounted price, okay? So therefore, I have to give back a portion of the sales tax money back, and I also have to write off what they owed me, right? So first, obviously, right, I'm going to recognize first things first is how much did they actually owe me to begin with? What did I originally record that they owed me? In this case, they originally owed me $10.92.50, right? Then I need to go ahead and realize how much did I actually sell to this customer, right? I sold 100 hats at $10 each. So that means my original total sales price was $1,000. That's the only amount that I can discount. I can't discount tax, and for sure I cannot discount delivery. Okay, so that means I can only take the discount off of the $1,000 that I sold. So in this case, $1,000 times that 5% is going to give you $50. Okay, and how much portion of that tax money back simplest way to do this is going to take your actual amount that you're refunding, which is, or in this case, discounting, which is the $50, right? Multiply the sales tax by that, and you'll get $4.13 that you have to take off as well. Okay? So then that means at the end of the day, if you did your total debits equal your total credits, that means you should be receiving a payment of $10.38.37, okay? Which will include, right, the total amount that they owe minus what you discounted minus the tax money that you had to give back as well. So in this case, they only are going to be giving you $10.38.37 because they received the 5% discount. All right. So, and because they end up doing that, right, you don't need to recognize anything, right, because it's a discount. They're not returning the product back to you. So that's all you're going to recognize is just the payment, right? Because you already recorded the sales. You don't need to update your inventory because they're not returning the product back to you. Okay. Any questions in regards to the last 3 sections of chapter 7?
You mind if I walk through that one more time on this? So what we're doing with this last one here.
Okay.
Go ahead and leave the numbers up on the last thing that we had. I just need to walk it through in my head.
Okay. So
what we're doing then is when they go to pay and we go put it down, we put in accounts receivable the full amount that they owed us originally, correct?
Yes.
The $10.92.50.
Correct, right? The $10.92.50.
The account receivable.
Yes.
Then we figure the sales discount on the product cost only.
Correct.
Okay. And then the sales tax is on the discount amount.
Correct.
And we add those together, deduct them from accounts receivable, and that's the cash we get.
Correct.
Okay. All right. I just had to run it through and make sure I had everything connected correctly. So
no worries. You can also do it this way too. So if this makes more sense to you, right? You can also figure it out this way where, okay, the person is paying for what they owe me, okay? So in this case, so I could just do the same thing as what I did for my in-store discount, right? Where I can rerun the numbers and figure out what they actually owe me, okay? So instead of cash, I could say accounts receivable, right? Accounts receivable should be whatever I'm going to charge them, right? So if I sold to them $1,000, right? Right? If I sold to them $1,000 and this because they're being discounted, right? Then I'm going to recognize that sales discount as whatever it was, 5%, which is the $50. Okay? You could do that and calculate and then figure out, okay, well, what is $950 times the tax, right? And then add that up together plus the delivery charges. That's going to give you the total amount that you should be receiving. Okay? You could also figure it that way as well because that would be also a correct way to do it as well. In this case, just to make it a little more easier so you don't scramble with too many numbers, it just more easier because you have these numbers already available to you. Okay? And it might be just a little more easier to do it that way instead of going back and recalculating the sales to how much they're supposed to be giving you at the end of the discounted price. Right? Okay. So this is just, it doesn't matter how you figure it out, as long as you get the same answers, you can solve it that way as well.
Okay, thank you.
Any other questions? Okay. So in the last 3 sections of chapter 7 here, we recognize that we had a purchase, but we recognize that sales influence your inventory. Okay, that means purchases will increase your inventory, sales will decrease your inventory. Okay, Straightforward. Okay? And everything that we place is going to go either in inventory and they're going to be taken out of inventory. Okay? We recognize that we have a cost of goods sold, which is taken out directly out from inventory. Okay? We also recognize what happens when a sales returns an allowance happens, right? If you're getting a full refund and the product is coming back to you, not only do you have to give them back their money, you also have to update your inventory because you're getting essentially the product back. Okay? Whereas an allowance, right, you're only giving a portion of the money, but you're not getting the product back because you're telling the customer to keep the product. So you don't need to update your inventory. Okay? And we talked about the two different types of discounts, right? If you're doing an in-store discount, you're going to take the discount right away at time of purchase and receive the money. Okay? Whereas the terms, right, if you allow your customers to owe you on an account and you supply them with a term, then it's a condition, right? They have to pay you in order for you to take that discount. Okay? But at the end of the day, the discounts are all taken directly out from the inventory account. Okay? All right, so let's go ahead and spend the next couple minutes here to go ahead and complete the chapter 7.4 all the way to 7.6 perpetual inventory sales exercise. Okay, so here it goes, a pretty short one. Okay, so number 1, journalize. Assume that sales tax is 8.25%. You purchased the total of 500 cups with all costs equaling to $1.36 each. Okay? So, first one here is on April 5th. You end up selling 100 cups at $5 each to customer A for cash. Okay? So, April 5th, we sold to customer A a total of 100 cups at $5 each to customer A for cash. Okay? So how do we recognize this?
Cash is debited $500.
Okay, don't forget the sales tax. All right, I assume that sales tax is 8.25%. So you have to recognize you sold something. And what else do you need to recognize? That you had to charge sales tax. Okay? So in this case, you were correct there where sales, right? We sold 100 cups for $5 each. So that means we sold a total of $500. How much is my sales tax?
Sales tax is $41.25.
So how?
We received $41.25.
Good. Okay. Now you can choose to do this. You can put your description in here saying that you sold X amount of cups, right? But what you can do, because these are related to each other, you can just link them together as one. So in this case, I don't have to have a description for every single transaction. I can break it up if I choose to, or I can link one description to 2 transactions because they are related to each other. Okay? So in this case, I sold 100 cups. So what does that mean? What do I have to do?
You need to adjust your inventory.
Yes. And how do I do that?
Okay, cost of goods sold would be debited first.
Good.
Or we sold how many? 100?
We sold 100 cups.
At one, so for $136.
Good, because that's what it cost me. Good.
And then our inventory is credited that amount, correct?
Yes. So in this case, what was my inventory called?
Mugs or cups?
In this case, yes, good. So cups. So that means I'm going to be updating my inventory cups. for exactly that 136. So in this case, right, you could say you sold 100 cups to customer A. Do you need to have the actual cost price? You can if you want to, but again, that's the purpose of the inventory worksheet, that you don't necessarily need to put it in here because you have the inventory worksheet to begin with. Okay? But for now, that should be good enough. That you sold, at least you identified that you sold 100 cups to customer A. Okay? So then April 7, you end up selling 25 cups for $5 each to customer B on an account, and you give him terms of a 10%, 15, net 30. Okay? So you sold 25 cups to customer B on an account, okay, on April 7. So how would you journalize that?
Okay, sales is 125 even.
Okay.
Whoops. Tax is 1031.
Okay.
And accounts receivable would be, well, I don't know.
Okay, so hold on.
135 something.
You said sales, right? You sold 25 cups at $5 each. So that gave you 125.
Right.
And you said
tax on the sales is $10.31.
okay. So therefore, your accounts receivable is
135.31.
good. Okay? And because you sold to customer B on an account, right? Because in this case, you sold it whether you received money or not, right? It's gone. So in this case, right, I need to also update my inventory because I sold 25 cups to customer B, okay? And I gave them terms of a 10% if they paid within, how many days? Oops. If they paid within 15 days, if not the whole entire bill is due in 30. Okay? So what is 25 times $1.36? How much did it cost you to sell those 25 cups?
$34.
Okay, good. All right, so let's see what's next. On April 10, you sold 50 cups for $5 each to customer C for cash. Okay. Okay, so you sold 50 cups for $5 each to customer C for cash. So in this case, I would highly recommend, because you're separating your transactions on two separate pages. So in this case, I would need to recognize that I sold 50 cups to customer C. Okay. Do you need to have your selling price? No, because that should be a standard thing that should be in your business at all times. So you don't necessarily need to put the sales price here. So in this case, if I sold 50 cups at $5 each, what's my total sales?
250.
What's my sales tax?
2063.
Good. So in this case, 270.63 is what you should have received from customer C. And last but not least, I also need to update my inventory because I sold some cups to customer C. Okay, so here we are. Cost of goods sold, it is April 10. Okay, and I sold 50 cups to customer C. Okay, so in this case, how much did it cost me to sell those 50 cups?
$68.
$68. Right? $1.36 times 50 give you $68. Okay. So then let's see what happened next. If on April 15, customer A decides to return 10 of those cups for a full refund. Okay. Customer A decides to return 10 of those cups for a full refund on April 15. Okay. So, how do I recognize a refund to my customer?
Okay, you'd have sales, returns, and allowances
Good.
for $50.
Okay. What else do you need to include?
You need to have your sales tax on there,
You
payable.
need good sales tax payable. So again, the customer is returning 10 mugs. You originally charged them at $5 each, so $50. How much sales tax money are you actually going to be giving back?
$4.13.
Good. And how did customer A pay me?
Cash.
They paid you in cash, so you're going to refund them with cash.
Okay.
Okay.
For $54.13.
Okay. So in this case, right, you can make a note saying that customer A returns 10 cups, full refund. Okay? Now, customer A returns 10 10 coffee cups for a full refund. So what does that tell me?
That says you've got to increase your inventory back up by 10 cups.
So for instance, that's exactly what I have to do. I have to put my inventory, I have to put it back into my inventory, and what else do I have to do?
It goes into cost of goods sold, doesn't it?
You got to reverse the cost of goods sold because it's as if you never sold it. Okay?
Right.
And I can make my note again.
$13.50 on each.
Okay. Customer A returns 10 cups. Okay. So 10 times $1.36 gives me $13.60. Yes.
Since we know we're selling cups instead of inventory, it's same as the cups.
Oh yeah, sorry.
Right.
Yeah. You're right. I forgot. Cups. Good. All right. Okay, so there goes that refund there on the 15th. Then on April 20th, customer C returns 25 cups but is willing to accept a 15% discount. Okay? So customer C is trying to return, but we convince him to keep them and is willing to accept a 15% discount. So how do we recognize that one?
Okay, so sales, returns, and allowances
Mm-hmm.
would be $18.75, a debit to that, right?
Okay, so
And
how
then
did you get 1875?
Oh, no, I took a, well, don't you take it by the, yeah, you take the $5 times the 25, because
Mm-hmm.
that's what he paid.
Mm-hmm.
And then you deduct the whatever for 15%.
Good,
And then,
right? Good.
so that's what the discount is the 1875.
Good. So 25 cups at $5 each times that 15% discount gives you that $18.75. Good. Okay. Now, in this
But then you
case,
also have to put your tax on that, don't you?
yes, you do, because it's not based on the quantity. It's based on how much you actually sold in terms of sales price. So in this case, if I end up refunding them their $18.75, how much tax am I going to actually be also refunding as well?
$1.55.
$1.55. So therefore, they paid in cash, right? We recognize that from above. If you read above, customer C paid with cash. So in this case, how much money am I actually refunding to them?
$20.33.
Okay. So again, and we can say customer C returns, actually, okay, I guess I could put allowance for 25 cups for 15% discount. Okay.
And since they kept them, we don't have to make an adjustment.
Excellent. Good. Good, right? Because they still end up keeping the cups, right? So we don't need to return the product back to our inventory. Yes.
I got 1875
Eight.
for the refund.
Oh, yes. Sorry, typo.
Okay.
1875, right?
Okay.
Okay. 1875 plus the sales tax of 155 should give you your total there. Okay. Last but not least, okay, on April 22nd, customer B pays for his purchases and meets the discount. So let's take a look at his transaction here. So April 7th, okay, we sold 25 cups for $5 each to customer B. On an account, he's going to receive a 10% discount because he definitely paid within 15 days. He paid on the very last 15th day. So in this case, he made the discount due date, so therefore we have to honor his 10% discount. So let's take a look at that transaction on April 7. So here, this is what we originally charged him, right? $135.31 because we sold to him 25 cups at $5 each, and we charged him sales tax for $10.31. Okay? So how are we going to journalize this transaction now that, let's see, how did customer B pay us? Okay, assumption here, they probably paid with a check or cash. Okay, so I'm just going to say they probably paid with a check. Okay, so it is April 22nd. Okay, if they paid me with a check, that means I'm going to be increasing my checking account. Okay, what do I need to recognize here?
You need to credit accounts receivable.
You need to credit accounts receivable, okay?
And your sales discount.
Your sales discount. Not credit. You need to debit the sales discount.
Yeah.
Okay.
You got a space there, so there's something I'm missing.
Yes. Because in this case, right, we originally, okay, so how much does customer B actually owe me in grand total? Okay, so April 7, how much did customer B buy from us and how much did we charge him in grand total?
Okay, accounts receivable was 135.31.
Good, right? That was the full price of what they owe me, what customer B owes me, right? $135.31. We're taking a
But sales
discount now.
was 125.
Yes.
So we take the discount on the 125, right?
Mm-hmm. So the discount was 10%,
Yeah, that's $12.50.
$12.50. Okay. Now in this case, when I recognize the accounts receivable, what did I charge my sales tax as? Where's the transaction? Right here, April 7th. What did I charge my sales tax as?
We charged it on the 125.
We charged it on the 125. So that means how I have to also give a portion of that sales tax money back, because how much is customer B actually paying me? He's only paying me for whatever 125 minus that 1250 is.
Right.
So in this case, how much sales tax money am I actually going to also take off of this amount?
You take 10% off the sales tax that was there.
No, you do not take 10%.
Don't you give them back the 10% discount?
Oh, okay. I see what you mean. I thought you said 10% off of the sales tax. No. But yes. Because we gave him a 10% discount, so the discount amount is $12.50, right? Yes.
Right.
You're going to calculate the sales tax off of the $12.50.
So that would be $1.03.
Okay, $1.03. So, how much is customer B actually going to pay me?
$121.78.
Yeah.
Good, right? That's what he's actually going to pay me because he received that 10% discount. And I'm also going to recognize that. Receive payment customer B. Okay. And then I'm also going to say received 10% discount. Okay. And you could say he paid with some kind of check, right? I'm not going to put it, but there you go. Okay. So in this case, right, we're recognizing that he's paying for what he owes, but he's also receiving the 10% discount. Okay. All right. Yes. Yes.
I have two questions.
Okay.
So we are saying received. It sounds to me like we are receiving a 10%, but are we giving them a discount?
Yeah, because they're receiving it on their end.
Okay, so that's why you're using word received.
Yeah.
They are okay.
Yeah.
And on the review slide for this part, you didn't put the sales discount on the sample.
It depends whether they paid or not.
Yeah, so if vendor paid a within payment date, which is 15 days, you are doing a checking and sales discount, and it goes to account receivable. But on the sample before it, we are charging sales tax.
Okay, that's because in the example I didn't include sales tax because if you do charge it, then you charge it. If you don't, then you don't.
Okay. So we need to charge the sales tax.
Because there are some occasions where if you're a wholesaler, you're
Yeah.
not 100% always obligated to charge sales tax.
Okay.
Mm-hmm. So there is a rule that you can tax exempt for certain occasions.
Okay. So for the review slide,
Mm-hmm.
you didn't give them a sales tax refund for these, even though they paid within the 15 days term.
Yeah, because if you didn't originally charge it in the first place, then there's no point to refund the sales tax.
We did charge sales tax of $41.25
On the PowerPoint?
Yeah.
On the review?
Yeah. Sales discount.
That's a sales discount.
Okay.
Sales discount is always on the selling price. It's never on the tax.
Well, it said on January 5th, you sold 100 cups at $5 each on account. Sales tax is 8.25%, and the delivery fee was $10. You gave the term 5%, $15, 15 days, and net 30.
Okay. So you're talking about the example. Hold on, let me